Taking a look at the charts, equities are down again today. If we look at the SP 500 and zoom in a little bit here, we've got a big down day on Friday, continuing to see more selling this morning. Now, I think we might see a little bit of a pivot low here. We've had some panic selling. We've had the put-call ratio pretty high. That fear is kind of carrying over. We'll see how that unfolds. But again, the markets are definitely having a downtrend. When we look at our SP 500 chart, clearly the market trend has reversed. It's kind of gone from an uptrend to neutral. And so now it's starting to more or less kind of break down here and set to open lower at this point. It could be an exhaustion low. We might see a bounce in the market to come back up into the mid-level here, or maybe connects to these highs. But the SP 500 is showing signs of weakness. The NASDAQ gave us weakness quite a while ago. We came all the way up, hit a 10% target, and then the trend ended up changing. And of course, it's trading lower as well, giving us a little bit of a heads up that the market, the leaders are underperforming and losing their momentum before the general market, which is the SP 500. Now, if we take a look, let's just jump into the news, take a quick look here. We got stocks tumbling, talking about traders worrying about doubt over rate cuts. I think that is a serious problem here. We've got unemployment going down. The Fed might not cut rates. This is going to affect the bond market, obviously, probably mortgage rates. If we take a look, let me just reload this page here. We've got the 10-year yield. If we take a look and zoom way out on this chart, we can go way back in time. It's gone from it's hard to see these dots, but a falling interest rate environment to a rising interest rate, and then back down to this 40-year downward cycle. Now we've got this move to the upside. And who knows? The market does what most people, generally the majority of people, don't expect it to do. And if we zoom in on this, and again, I'm going to do a video here soon on Fibonacci extensions. I would do it in eSignal, but I don't have this the 10-year in eSignal for some reason. If we take a look at Fibonacci extension, we can look at this low and bring it up to, got to figure out how this works here. We go from the low to this high and down to this low, and it's going to carry forward where our upside targets are. Now, if we were to take a look, again, I don't use this too much, but 618 is usually our first target, which is right up here, and then 100% measured move. And as crazy as this sounds, there is potential that inflation skyrockets. Who knows what Trump is going to do, that we see this market rip to the upside, hit a 618, have some hiccup in 2025, and we continue to see rates go all the way up. So 6.5 all the way to 8.something%. Of course, this would wreak havoc on all kinds of markets. This is what I don't think this will happen, but there is still a possibility this could happen, and this will annihilate the real estate market. Right when everyone goes all in on real estate and they all think it's going up and up and up, and they all have all this crazy wealth, this could be one of the biggest resets in most retirees. Anybody with real estate is going to get hammered. Higher rates mean falling pricing for housing. They'll just flood the market. People will go broke. And that leads us right over into really where we are in this housing market. The housing market had the COVID bubble, and we are on the verge of breaking down and seeing single-family home prices drop. And it's not just this. It'll be commercial will get hammered. Everything will get hammered. Industrial, businesses will struggle. So we could see a huge unwinding event. If rates hold up or start to push higher, man, the real estate market is going to get hit. And I believe the real estate will probably be the tipping point for the economy, simply because most investors in the stock market also own their own home. They have rental properties. And once they see home prices falling 5, 10, 15% and picking up speed, they're going to feel the pain of loss of net value, net worth. And then they're going to see the stock market going down, and they're going to get hit from both sides. Their good old passive real estate is getting hit hard. They're losing money. Their portfolio, their retirement accounts losing money. And that will tighten people's wallets, and they'll stop spending, stop traveling, all that stuff. And that's when business and sales drop. And the unemployment will spike through all of this as well. All right, so in the general scheme of things, I still believe we're in this major stage 3 topping phase. It's camouflaged with the indexes because of big heavy tech, but the reality is the majority of stock market is trading in this sideways move, really just testing a double top. And we're about to go off a cliff into a financial reset. Now, that's what I believe is going to happen. If the markets do continue to rally, of course, we'll just play the long side and get right back in once we have a new trend buy signal. But we need to be aware of this. And what's interesting is, if we take a look at where we are in the overall scenario of things, we are at this red top here, peak maximum financial risk. I don't care almost what asset class you get into, there's not much upside. I believe kind of the only upside I think potential is actually the US dollar index. I think we're going to see the US dollar skyrocket, and everything else is pretty much going to go down. And we can take advantage of falling pricing through inverse ETFs, or we can ride the dollar up. There's a few different plays that we can do and that we're actually doing already. So that's kind of how we go about that. Now, one other interesting thing here is if we look at the job openings, the 3-month and the monthly chart here, we have been seeing job openings really since 2022 have been going down. So we got some big divergence here. There's fewer and fewer job openings. We do have unemployment coming down, but I'll share another chart with the unemployment another time. But we are really in the same stage, I believe, just before the big crash in 2008 took place when it comes to unemployment, and I'll share that in another video. Let's jump right into the charts. Stocks are trading lower this morning. Fears carrying over. Expect volatility throughout this week. We did have some panic selling here last week. We saw a big bout of panic selling kick in. Really, it continued to have thresholds of panic selling for most of that session. And then Friday at the close, we saw it spike above our blue line here, telling us that we're oversold again. We'll probably see some type of pause or bounce. Now, keep in mind, the key with a downtrend when these bars are red is when we have these oversold levels, it just means there's going to be a bounce or a pause. It doesn't really mean it's a buying opportunity. When the bars are red, what ideally a trader's looking for is when there's FOMO, when our FOMO indicator where everybody's buying is piling into the stock market. When everybody's piling in, that's typically when we're going to see the stock market move down. We have these bouts of selling take place. And so when we're in a downtrend, these bounces or these oversold conditions are not a buying opportunity. They're just a pause or small bounce. The majority of the easy money is going to be to the downside during a downtrend. You don't want to try and pick a bottom when stuff is falling. Let's take a look where money is flowing today. We do have bonds up 0.17%, so very little here, trying to find a little bit of traction. Again, bonds have been out of favor for a long time, and they're not looking good. If the yields, the interest rate continues to hold up or climb, we're going to see the bond market fall off a cliff again. It's going to continue to go down, and people have been trying to pick the bottom in bond market for the last couple of years. And I've been talking about how dangerous it is because we don't know what's going to happen. If we've had 16, 17, 18% interest rates in the past, it could happen again. We could have anything happen. So there's no point trying to pick a bottom because no one knows where a bottom is. Good point. Who thought oil could go negative? So don't try and pick a bottom because the bottom is always way lower than you possibly can imagine. And anything can happen in these financial markets. So money is flowing into the dollar today. We're seeing gold. Actually, let's just jump over to gold real quick. Gold, when there is panic selling in the market and fear, we tend to see gold move down with it. So it doesn't act as a true safe haven during a bloodbath and a bear market and things like that. We are seeing gold move down, and the money is flowing into the dollar. The dollar continues to push up and is moving higher. And I believe we're going to see the U.S. dollar continue to rip higher for quite some time. It'll obviously have some pullbacks and pauses along the way, but overall, I like the dollar, especially from a Canadian trader standpoint. If we just take a look at the basket of the core currencies, the dollar is up, everything else is down. Obviously, money is going to want to naturally flow to the currency that is going up in value. So this is like a self-fulfilling prophecy. Everybody's dumping their own currencies. They're moving to where the money is. As a Canadian, when we take a look at the Canadian monthly chart, this goes way back to 2000, the peak that we saw back in 2001, 2002. We've got this massive cup and handle pattern or bull flag, whatever you want to call it. And I believe we're going to see this currency exchange. Right now we're at a $1.44 exchange. So $1 US is $1.44 Canadian. I believe we're going to see it go all the way up to 160. And I think I did Fibonacci on this as well. And it shows about 174, which would be absolutely insane. So I believe there's going to be some massive changes going on around in the world, economy, assets, and people who aren't ahead of the ball game and don't know how to manage and protect and get rid of assets that are going to get crushed are going to have a pretty rough ride this year. Let's go take a look over at oil. We do have oil pushing up to 6 months highs, so it is continuing to push and muscle its way up here. It's testing this high again, just pierced it this morning. So we do have money kind of moving into this space. I think there was some more news around it. In the grand scheme of things, again, I am more so neutral to bearish on oil. In the grand scheme of things, it is making a series of more or less lower highs. It's been holding support here. I think this is a short squeeze and a bounce. I feel eventually it's going to resolve to the downside and have a big break. When we have weaker economic numbers, something will trigger it at some point. But again, I'm not really interested in this space at this point. An interesting thing there, if we take a look at last week, let's just take a look at the markets. We look over here and let's take a look at the weekly chart. The SP 500 last week, just if we take a look at where it moved, it ended up from the previous week, it ended up closing down 1.9%, so 2% lower, testing this 20-period moving average. What's interesting here is if we go and we look at the dividend stocks, took a pretty good hit, down 2.8%, so down quite a bit more, and they do not look. It looks like the dividend space could be in for a heck of a crash and a sell-off as things go. And of course, this is where the majority of investors have their money and why they're suffering so much more than a short-term trader who's more so into the indexes and not these big high-yield dividend stocks. If we look at the Russell 2000, it's got a similar chart pattern as dividends. It has this drop, this bearish pattern and breaking down. And of course, if we look at the equal weighted SP 500, the Russell 2000, and the microcaps ETF to get a feel of the broad market. So large caps, small caps. I'm just going to go back to the daily here. I believe we're getting into a very similar space where we have something like this where it keeps holding up and then we see a pop and everyone gets bullish on the markets. We've been kind of doing the same thing. Everybody's been getting very bullish on the markets. They all piled in. This is where we've been talking about the ARK ETFs, all the aggressive Bitcoin. We've seen hail, solar, clean energy. All of this stuff have been performing really well. That's typically what happens. Everybody piles into this super aggressive stuff, thinking we're starting something big. They buy the most volatile, most dangerous stocks, more or less, just before we go off into a big sell-off in the markets. Last but not least, let's take a look at the big picture of the SP 500 and the overall 60-40 kind of buy and hold portfolio. When we look at these charts, the top here is the SP 500 weekly chart, and this is where we have our bullish, our biased bull market phase. We have a bearish phase. We are currently still in a bullish phase in the market, but let's take a look at the difference here between the buy and hold portfolio and the indexes, and then of course how we can also trade those investment cycles. So more or less from the high that we saw back in 2022, the stock market is up about 21%. If we look at the 60-40 portfolio, you're actually down about 4%. So that you just wasted a couple of years, no return. You're actually losing money on top of that. Versus if we were to take advantage of this with our other strategy here, our technical investing strategy that is woven into our other strategies here, you can see our most recent trade we got in, we're up about 43% there. After COVID, once we had our buy signal there, we were able to get in and lock up 41% over there. And of course, we avoided the bear market that happened in 2022. And we were able to buy back in at a lower price and grow the account. So as you can see, this same time frame, if we were to go from the same time frame with the 60-40 portfolio, somebody's up with a hell of a roller coaster ride, only about 22% versus this making 40+% to the upside, and then taking all that money and compounding it, reinvesting the new wealth into the new signal, and then driving that up another 43%. And so these are the underlying trends of the market. Ride the bull markets, avoid the bear markets, and of course we actively trade these through here with the CGS strategy to pull out even more in certain scenarios. In fact, CGS is where we even made 6%, almost 6% during the bear market phase. So When you combine everything, there's so much potential to be done in this market when you understand, is the tide going up, is the tide going down? And then we want to catch the waves, those sets that roll through the market every year. There's 5 to 12. That's what we do with our strategies, and how we take advantage of the tides and how we take advantage of the waves, like with our CGS strategy. We catch these nice waves, we catch 3-10% targets, rotate out, move into a different asset, which we're in right now, that is moving higher as the stock market is trading sideways and falling. So we're constantly compounding and growing our account. That is the value that we bring, is that downside protection and how to profit from a sideways market. Anyways, other than that, we'll just let the market shake out this morning. We'll see how the day goes. We've got, I think, some economic data coming out today or this week, and I expect chaos kind of throughout the markets, but we are positioned perfectly for all of this. In fact, the bloodier it gets on Wall Street, the better it is for our position right now anyway. So talk to you soon. Bye-bye.